Hey guys, it's Matt. So this video will be part one of where we dive into supply and demand. So we'll be discussing the basics of supply and demand and the difference between the two in the markets, as well as how to draw supply and demand zones if you're a technical trader. So if you guys enjoyed this video and you find it helpful, be sure to drop a like and of course subscribe to this channel if you haven't yet subscribed. So first let's start off with the basics of supply and demand before we tie this into trading. So when it comes to any given market in the world, supply and demand is always present, which is simply showing us a dynamic relationship between buyers and sellers. And so if we think of buyers, we can think of demand, and if we think of sellers, we can think of supply. And the distinction between the two when it relates to a certain good or asset is that obviously, if you're someone who's a buyer, you will want to buy something for the cheapest price. You don't want to pay a lot of money. Whereas the opposite is true if you're someone who's a seller. So if you're a seller, then you want to sell a certain good or asset for the highest price in order to make the greatest profit. So if we think of a certain good that's rare and maybe collectible that's being sold today, so maybe a famous piece of historical art, or maybe something that a celebrity decides to sell. So it might be one of those crazy stories where a celebrity is selling an autograph or a t-shirt that they own and someone out there is willing to spend thousands of dollars on it. So this is something that might increase the overall price of a certain good because the quantity is pretty low. But now if we think of an item that has an infinite quantity of it and it's readily available to us, so we might think of something like the air that we breathe outside, or perhaps the grass that you might see outside, because there's so much of it and it's easily accessible to us. And so this is where the demand for it is likely to go down, as well as the overall price. And so this is basically the relationship between buyers and sellers, or the overall demand of an item and the overall supply of an item. And this can change depending on a number of factors. So let's imagine an example where there's a TV that's being sold for $1,000, and this TV might have a 4K display and it might be 70 inches in total size. Well, then if $1,000 is something that sellers feel is worth selling this product for with a profit that they can make, and $1,000 is something that buyers are willing to pay in order to get this TV, so they don't feel as though they're being ripped off, well then now you have a happy middle ground, and this is where you get equilibrium in the market. But if all of a sudden there's a shortage on these TVs and now there's a limited supply, well then this is where the overall price might go up again. So the availability of this TV goes down. Well then this is where this TV might now start selling for $1,200. Or in another example, you can buy this TV for $1,000, but you typically have to wait 1 month. Well, now you can see how on a website such as eBay, you might have a seller that has collected a bunch of these TVs. Well, then he might raise the price as well to perhaps $1,100. And this is where you might get the TV within 2 or 3 days. So if we think of all of this as it relates to analyzing a chart through technical analysis, so we might have a certain stock or perhaps an altcoin that we're analyzing. Basically, we know that the y-axis will be the price and the x-axis will show us the amount of time that has passed for when this certain asset has been trading. So let's imagine a company in the beginning that is relatively new and unknown, while the overall stock price of this company in the beginning won't be as high compared to what it's valued at after a number of years. And the same can be said for an altcoin, where in the beginning, the price of it will be low, but as the demand for it increases over time, and let's imagine that the overall project that's behind a certain altcoin is pretty good, well then the market demand will go up and then the price of it will gradually go up over time. Now there's a number of other factors that will affect the overall price in the beginning. So obviously the total supply will affect the absolute price. And so the fluctuations that we see in the markets when we are analyzing a chart is essentially the fluctuations between buyers and sellers. So the fluctuations between supply and demand. And so if we think of the value of an asset that slowly goes up over time, and let's say that it reaches a point of where it's deemed a little bit too expensive for a lot of buyers to purchase it for, and this might also coincide with some sellers wanting to obviously take some profits. And so this is where once the sellers will start to sell off their positions, and this is obviously going to be for the most part affected by the largest sellers. So if we think of the CEO of a company, or maybe one of the original developers behind a certain altcoin, where they own a large portion, or maybe they might own 10% of the total distributed supply. Well, once they decide to sell, this will gradually push the market down. And so supply and demand zones are basically price regions where in the past there was either an abundance of strong buyers that overpowered the sellers, or a region of strong sellers that overpowered the buyers. And that's a big reason as to what would cause the price action to push quickly away from out of these zones. Now, let's keep in mind that when it comes to supply or demand zones, the big buyers or the big sellers will be the institutions. So even if the average person, or maybe you might have 100 people or 1,000 people, even if they choose to sell at a certain price, if an institution which obviously has way more money, if they decide to buy and push the price action further up, well, then they will overpower the sellers, and that's where it's going to go up. And so these price regions where there was either a lot of supply or a lot of demand are regions where if they get potentially retested again in the future, based on the law of probability, there's a greater likelihood that there could be another strong reaction to one of these price regions. And supply is drawn from the top. So supply would be near the highs of where there's an abundance of strong sellers before the price action pushes down. And then a demand zone would be near the lows. So this is the region where there's an abundance of strong buyers that accumulated within a price range before price action pushed to the upside. Now, there's obviously more into this, so there's more variables in the market that need to be accounted for. Now, the benefit of marking out potential supply and demand zones as a trader is that, one, it can help us find better potential entries. And that's obviously because if we expect there to be some sort of reaction to price action retesting a region where in the past there was a lot of demand, and so we expect this price region to also have a lot of demand if it gets retested, well, then if you were to enter a trade, this will give you a better risk to reward ratio, and this coincides with typically having better entries. And this is why a lot of traders might trade supply and demand zones by using a bunch of limit orders. And a limit order is set automatically so that you don't have to manually execute a trade, and they would set it near or in the middle of a potential demand zone or supply zone, and that's where they would look to buy or sell if it gets retested again. And supply and demand zones are not just used for entries, they can also be used for take profit points. And that's because if you're someone, for example, let's say you're someone who's a buyer where you bought an asset at a low price, so maybe you entered over here before the rally, well, you obviously want to close your trade at the most expensive price so that way you can make the most amount of profit. However, you don't want to wait for price action to reach an area where the demand becomes incredibly low, where buyers don't really have an interest in buying as much, and the sellers have a greater interest in selling now, because if you wait for price action to reach a strong region of potential supply and it drops down, well, now you're not making as much profit. So ideally, this is where some traders will look to sell right before a supply zone is touched by the market. And this is also where, if you're a seller and you want to make the most amount of profit, well, then you would be looking to close your trade in the middle or right before price action reaches a potential demand zone. And that's because if you wait too long and price action touches a demand zone and then there's a massive correction, well, then you're not going to make as much profit. So I hope you guys enjoyed part 1. And as a reminder, I will be going more in depth into this with live examples in part 2. So this is only just a brief introduction of supply and demand. But regardless, if you guys found this helpful, be sure to drop a like and also be sure to join my trading community if you haven't joined yet. The link is down in the description of this video for anyone to come and join. Thanks for watching. I will see you in the next video.